So you want to run a charity. Sounds like the purest business idea in the world. People hand you money because they believe in a good cause. You use it to help people, and everyone walks away feeling good about it. That's the picture in your head, and it's not entirely wrong. Look at any major charity's website, photos of smiling kids, grateful families, disaster relief in action, and you think, this must be simple. Collect donations, do good, repeat. Here's the problem. That warm feeling you get scrolling through a charity's homepage is the most misleading part of the entire operation. Running a charity isn't really about collecting donations and handing them straight to people in need. It's running a full company, with payroll, rent, insurance, compliance, and marketing. Except this company has to justify every single dollar it spends to a public that assumes the whole thing should run for free. And once you understand that tension, the entire economics of the nonprofit world starts to make a lot more sense. Let's start with a basic fact that surprises almost everyone. A charity is not legally allowed to have owners in the way a normal business does. Nobody can start a nonprofit, run it successfully, and then sell it for a profit or pocket the leftover money at the end of the year the way a business owner would. Any money left over at the end of a charity's fiscal year has to be reinvested back into the mission, not distributed to whoever's in charge. So the very first thing to understand is that running a charity was never a path to personal wealth through ownership. Whatever financial reward exists here comes entirely through salary, not equity, and that changes every other number in this picture. Now let's talk about what it actually costs to get a charity off the ground, because most people assume you just need an idea and a bank account. Setting up a legal nonprofit structure properly, filing paperwork, securing tax-exempt status, setting up proper accounting systems, can easily run several thousand to tens of thousands of dollars before a single dollar has gone toward the actual cause. And once you're operational, you're not running a small errand. You're running an organization that legally has to be transparent about where every dollar goes, which means hiring an accountant, often a compliance officer, and eventually an auditor, purely to prove to regulators and donors that the money is being used the way it was promised. Here's where the real controversy in this industry begins, and it's worth walking through carefully because it's widely misunderstood. Charities need staff, real, skilled, full-time staff, to run programs, manage donor relationships, handle finances, and actually execute the mission at any meaningful scale. And skilled people, the kind capable of running a multi-million-dollar operation responsibly, generally won't work for free indefinitely. A charity's executive director, particularly at a larger organization, might earn anywhere from $60,000 a year at a small local nonprofit to several $100,000 a year at a major national organization, which sounds like a lot until you compare it to what that same level of experience would command running a similarly sized for-profit company. The uncomfortable truth is that if charities refuse to pay competitive salaries at all, they'd struggle to attract the exact talent needed to run large, complex operations responsibly, and the mission itself would suffer for it. This is exactly why the concept of overhead, the percentage of donations spent on staff, rent, and operations, rather than directly on the cause, is one of the most misunderstood numbers in the entire nonprofit world. A donor sees a headline saying a charity spent 30% of its budget on overhead and assumes that's wasted money. But that 30% often includes the program staff who deliver services directly, the systems that track whether the programs are actually working, and the fundraising operation that brought in the donations in the first place. A charity that spends almost nothing on overhead often can't scale, can't measure its own impact properly, and frequently can't survive past its founder's initial burst of personal energy. Some of the most effective, well-run charities in the world deliberately spend a healthy percentage on overhead, because that overhead is often what makes the actual program work reliably instead of collapsing after a few years. Now let's talk about where the money actually comes from, because donations from individual people are often just one piece of a much bigger puzzle. Major charities frequently rely heavily on large institutional donors, corporate partnerships, and government grants, sources of funding that come with their own strings attached. A grant from a government agency or a foundation often specifies exactly what the money can be spent on, sometimes down to the smallest detail, which means a charity might be sitting on funding for one specific program while genuinely struggling to cover the basic operating costs of running the organization day to day. This is why so many charities run specific, separate fundraising campaigns just to cover general operating costs, because donors are often far more willing to fund a specific, emotionally resonant project than the unglamorous electricity bill that keeps the building running. Here's a pattern that will feel very familiar if you've ever thought about how a gym or a subscription service makes money, because the exact same psychology shows up here. Monthly recurring donors, people who sign up to give a small amount automatically every month, are enormously valuable to a charity, not just because of the total amount raised, but because of the predictability. A one-time donor who gives a large sum once is wonderful, but a charity can't plan its annual budget around hoping that same person feels generous again next year. A recurring monthly donor giving even a modest amount creates a stream of dependable revenue a charity can actually build long-term programs around, the same way a gym prefers a member who pays every month over someone who shows up once and leaves. And just like a gym membership, a meaningful percentage of recurring donors eventually stop paying attention to the charge on their statement entirely, which, while not the point of the arrangement, still keeps that predictable revenue flowing in. Seasonality plays a massive role here too, in a way that mirrors retail almost exactly. A huge share of annual charitable giving happens in the final weeks of the calendar year, driven by year-end tax deductions in many countries and a general seasonal spirit of giving. Charities plan their entire fundraising calendar around this window, often generating a significant portion of their annual budget in just the last 6 to 8 weeks of the year. This creates a genuine cash flow challenge for the rest of the year, because the bills for staff, rent, and ongoing programs don't pause just because donations naturally slow down in the quieter months. Let's talk about a cost that almost never gets discussed honestly, which is the cost of proving your impact. Donors, foundations, and government grant programs increasingly want hard evidence that a charity's programs are actually working, not just heartfelt stories. Building the systems to properly track outcomes, following up with the people a program served, measuring results over months or years, and compiling that data into reports costs real money and real staff time. A charity that skips this step might save money in the short term, but it risks losing access to the exact grants and major donors who now expect that level of evidence before writing a check, which means measurement itself has become a genuine cost of doing business in this space. Now, here's where the risk in this industry becomes uniquely brutal compared to almost any other type of organization. A single scandal, a misused grant, an executive paid an amount the public finds excessive, or even just an accusation that turns out to be unfounded, can devastate a charity's donor base overnight in a way that rarely happens to an ordinary business selling an ordinary product. People forgive a bad meal at a restaurant. They rarely forgive the sense that their charitable donation was betrayed. This is why reputational risk sits at the very center of how every major charity operates, often shaping decisions about executive pay, spending transparency, and public communication far more cautiously than a typical company would ever need to. So how does a charity actually function financially, in plain mechanical terms? Revenue comes from a mix of individual donations, recurring monthly gifts, major donor contributions, corporate partnerships, and grants, minus the cost of staff, programs, compliance, fundraising, and overhead. The healthiest charities build a diversified mix of all of these sources, because relying too heavily on any single stream, one major donor, one grant, one seasonal fundraising push, leaves the entire operation vulnerable if that one source ever dries up. A charity with just a few $100,000 in annual revenue might run almost entirely on a handful of dedicated staff and volunteers, while a major international charity can be managing hundreds of millions of dollars across dozens of countries, requiring an operational structure that looks, in almost every practical sense, exactly like running a large multinational company, just with a different definition of profit at the very end. Put it all together over a full year, and you get two very different outcomes depending on how the year actually goes. In a strong year, a diversified donor base, a successful year-end campaign, and a well-earned grant renewal let a charity fully fund its programs, invest in measuring its own impact, and build a reserve for the following year. In a rough year, a major donor pulls back, a grant isn't renewed, and a public scandal involving an entirely unrelated charity shakes public trust in the sector broadly. That same well-run charity can be forced to cut programs, lay off staff, and scale back the exact mission it exists to pursue, even while its actual work on the ground was just as effective as the year before. So if you're seriously thinking about running a charity, remember the one thing that actually determines whether it survives long enough to make a real difference. It was never really about how good the cause sounds on a donation page. It's about whether you can build an organization stable enough to keep helping people on the months when nobody's watching and the donations slow down.